But the fact is, in every previous halving, basically what happens is the fair value of the network doubles. Now, there is one nuance this time, and I don't know if you've been following it very closely, but there's the whole development of ordinals a year plus ago, and now as of the halving, there was this development of runes, basically meme coins, or the technology to do meme coins on Bitcoin.
Hey guys, welcome back to Everyday Finance. In this video, Yusko discusses Bitcoin and crypto. Factor 10 years ago, investing $1 billion in Bitcoin seemed like a viable strategy because of its market depth and potential. Over the past decade, there has been a noticeable increase in available liquidity. The market has transitioned from being volatile with wide bid-ask spreads to a more stable global market, attracting professional investors and arbitrageurs. This evolution has naturally reduced the significant multiplier effects experienced by early investors, and lots of things Yusko discusses. So please watch the video to end, and share this video, and subscribe our channel Everyday Finance. Thanks.
Oh, right. I mean, the history tells us that the 12 months following the halving are the hyperbolic move cycle. And that makes sense, right? Just logically, what does the halving do? Well, it cuts the supply of block rewards that pay the miners for securing the network. So if the miners' costs are relatively fixed and their revenue goes down, in theory, a whole bunch of them would go away unless the price were to move. I think it's one of the most ingenious parts of the code, and there's a lot of ingenious parts to the code. But the fact is, in every previous halving, basically what happens is the fair value of the network doubles. Now, there is one nuance this time, and I don't know if you've been following it very closely, but there's the whole development of ordinals a year plus ago, and now as of the halving, there was this development of runes, basically meme coins, or the technology to do meme coins on Bitcoin. And everybody's talking about it, and some people hate it and some people love it. The reality is, what it does is it generates a lot of transaction fees.
Yep.
And transaction fees also reward the miners. So I think this time, instead of the fair value today, Tim Peterson would tell you is somewhere in the low 50s. I'll even round down to be conservative to 50. Normally in a halving that goes to 100. But let's say this time it only goes to 80 because the transaction fee offset. That's made up math, but it sounds right. And then in a normal cycle, we go to 2.3x fair value because of the FOMO and all the momentum and the leverage. But I think leverage is lower this time. So
100, 200.
Do we get to 150? Yeah, I think we get
fair
to
value is 80, and we 2.5 exit. We get to 200.
Well, I think we double this time. So let's say 150, 160, and that would be by April, May of 25. Exactly. So by the end of this, now I think it all depends. I've been saying that this is going to be the best Thanksgiving ever, right? No more, you're not welcome because you're a crypto person in the family. People are going to be like, oh, come on. It's going to be awesome. And people are going to celebrate the crypto people in the family this year. And so if that FOMO period is like the previous two, where from November to December, go up orders of magnitude. I mean, remember, we went from 10,000 to 20,000 in 8 weeks.
As Yusko pointed out, there has been a significant influx of capital, amounting to $15 billion into ETFs in a short period of time. In just 3 months, market prices can undergo significant shifts, as exemplified by the fluctuations in the price of Bitcoin. With Yo's comments in mind, it's evident that Bitcoin has the potential to reach a market valuation similar to gold. The recent surge from $47,000 to $70,000 further highlights this potential. If the crypto market were to absorb $300 billion, the theoretical valuation of Bitcoin could reach $6 trillion. This projection establishes a remarkable precedent for the counterparts of Bitcoin in comparison to conventional safe havens, such as gold. Additionally, Yusko's critical viewpoint on central bank digital currencies, CBDCs, further adds to the discussion. Emphasizes the notable privacy and autonomy concerns that may arise, which sharply contrast with the decentralized nature of cryptocurrencies such as Bitcoin. Let's back to the Mark Yusko interview.
Really important point, right? There are multiple factors in markets, and the biggest one really is supply and demand. Basic Econ 101. And we had a pretty significant demand shift. And it hasn't fully played out. In fact, it hasn't even come close to fully playing out. The math that always amazes me, I believe, in the next 12 months-ish, so we're a couple months, about 3 months into the ETF, and we've gotten about 10% of what I believe is coming into this space from the registered investment advisors that control all the boomers' cash. So the boomers have 30 odd trillion with these financial advisors. Not all of them will. UBS still hasn't said I can buy IBIT in my account, right? It's my money, my account. I can't buy it because they know what's good for me. Vanguard, same thing. So there's going to be 300 billion, I believe, that's 1% of 30 trillion, that comes in to this space. Scott, that's actually more money than has ever converted to Bitcoin in 15 years. Yeah. That's a pretty amazing thing, because what people forget is that multiplier effect of the bid ask, right? I convert some fiat into Bitcoin, but then I don't want to sell it. So someone's got to bid a higher price to get me to sell. And so you get that multiplier. And I don't think the multiplier is whatever Bank of America says, 118. Yeah. When we were talking pennies or dollars or $10 or $20, the multiplier was really, really big. Today, I'm going to say the multiplier's probably more like 20-ish. So 300 billion would add 6 trillion.
And not look.
Well, no, here's the crazy thing. In your 401k, not yours personally, but in people's 401k, they set the allocation on the day they start their job, and they choose 1 over X. So if there are 7 choices, they put 1/7 in each, and they never change, and they never rebalance. Not ever. So people putting this in their 401k, not the 401k, in their retirement account, their IRA, it's over. And to your point, they're not going to stare at it. They're not going to look at it. And this idea that number go up, that's not the point. The point is the utility is going to continue to go up. The embracing of the technology is going to continue to go up. And at the end of the day, it is a finite asset. People say, well, that Satoshi could show up and add more. No, Jameson Lopp showed us the lines of code that prohibit that.
Now, it's like 5 lines, by the way. Yeah. It's 5 lines of code prevent that entire narrative. But
yeah. And the thing is, fine, could 51% of the participants change that? Sure. But the likelihood of that happening is really low. And the reason behind it, why it might happen, could be really interesting. So it's kind of like a stock split. But all of that aside, the demand for blockchain technology, of which Bitcoin is a blockchain. I love this whole debate, right? Bitcoin, not blockchain, blockchain, not Bitcoin.
Yeah, of course.
Like they're the same thing, right? We have the Bitcoin network, that is a blockchain network, and the Bitcoin token, which secures the network through block rewards. I don't know why we debate this. Just makes no sense to me.
In his concluding remarks, Yusko emphasizes the long-lasting value of gold as a traditional asset base. The standard for many central banks globally, however, is being challenged by the rapid accumulation of gold by nations such as China. This suggests a strategic positioning for an economic landscape that is influenced by digital assets. As countries experiment with both gold and digital currencies as base layers for their financial systems, the idea of Bitcoin and other cryptocurrencies disrupting traditional financial and political structures is gaining traction. We are on the brink of a potential pivotal shift in global economic power dynamics. The integration of blockchain technology promises a shift towards financial transparency and independence, challenging the fundamental structure of how nation-states currently operate. This has the potential to create a future where digital currency becomes more than just an investment asset, but a crucial element of financial sovereignty. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.